Hey, thank you, Chrissy. Good morning, everyone. We appreciate your joining us today to talk about what's been happening with the IRS and with exams, notices, penalties, all of that area that we refer to as controversy, where the taxpayer and the IRS don't agree and what we can do about that. So let me tell you who our presenters are today. Uh, so Ann Oliver is an attorney. She has spent some time with the Department of Justice and with Big Four, and she's here and is our head of our IRS controversy and procedure group. In addition, David McCallum, also an attorney, and spent some time with IRS Chief Counsel's office. He is a senior manager with our credits and accounting methods team, focusing on issues, and particularly when it comes to examination issues in that area. And I am Sarah McGregor. I'm a director in our federal tax team, and I have been advocating for clients before the IRS and with the IRS for many, many years. So we all have experience working with the IRS and are attuned to the things that are going on. So, David, let's skip down to our agenda for today. So we're going to talk about some of the challenges that the IRS faced this year and how they did against that. We're going to talk about a perennial problem the IRS has in the tax gap. We'll talk about some examination issues and appeals changes or things that are going to stay the same. We'll talk about some trends and penalties. There's been some court cases and some attention paid to how the IRS assesses penalties. Finally, the IRS is changing how they will interact with taxpayers from a technology standpoint, and that brings us to a big centerpiece. What can we expect in the future as the IRS starts to on a plan to modernize its technology, and what does that look like? And finally, we'll touch on a couple of important issues or items, including some legislation and some personnel changes that are important to keep an eye on as we move forward into the second half of the year. So, David, let's talk about some challenges and that the IRS faced this year and the tax gap. So, first, let's talk about the challenges they had. There were a couple of big challenges this year, and I had to put a soccer reference in. I'm hoping that the U.S. women's team will do real well on Friday, but we'll just have to wait and see. But anyway, the IRS faced several really daunting challenges this year. One of them was implementing the Tax Cuts and Jobs Act of 2017, and they are still actively involved in that. We'll talk some specifics about how they did later in this presentation. They got a new IRS commissioner. He was selected and appointed, and that took some impact too. Anytime you transition the top leadership, it can either be detrimental or it can be a boost to an organization, as many of you know from your own experiences. And finally, we had one of the longest partial government shutdowns that we've ever had. 34 days, right there in December, January, heading right into the heart of the tax filing season for most 1040 returns. So how did they do against these challenges? Well, first and foremost, the extraordinary amount of guidance that has been issued, the revision to forms, the changes to publications, the computer systems that had to be changed, the education of the taxpayers and the public and practitioners was really, really extraordinary. So even with the stretched resources the IRS had, they were able to accomplish a great deal in this regard. Now, they're not done yet, and we certainly don't have all the answers we'd like to have, but considering what they had to start with and 12 months, less than 12 months to get it done, they really have pulled off a pretty amazing feat over 2018 and through the spring of 2019. Commissioner Chuck Rettig, is the new commissioner for the IRS. He was chosen and sworn in, and he's been an outstanding advocate and voice for the IRS employees, building confidence, building pride back in the organization. He's brought some new energy, a new direction, and for the taxpayer and tax practitioner community, he comes from that side. He has worked with taxpayers. He has worked as a tax professional. So he brings that side back to the agency and leadership in the agency, which is very helpful to us. And finally, amazingly enough, despite the shutdown, tax season started on time. They were ready to accept tax returns on January 28 as promised, and that was actually one day sooner than last year. But that doesn't solve all the problems that the IRS has. And Anne, why don't you tell us about this perennial problem that's referred to as the tax gap? What is that?
Thanks, Sarah. So GAO, which is the Government Accountability Office, did a study that they just released in May on the tax gap, which is the difference between the tax amounts the taxpayers should have paid and what they actually paid, both voluntarily and on time. Understandably, this has been something that has plagued the IRS for decades, and they've always trying to look for new ways to try and reduce the tax gap. It's an aggregate of all the 5 different types of taxes that the IRS collects. So it takes into account everything, which would be individual income, corporate income, employment taxes, estate and gift taxes, and then excise taxes. So this takes into account all the taxes that the IRS administers. And the latest tax gap estimate found the taxpayers voluntarily and timely paid about 81.7% of the taxes that they owed, which seems like a pretty high number, right? That's like a solid B. The problem is the amount of taxes that are owed are so high that actually leaves a tax gap of $458 billion, which is a huge number. And the net tax gap is about $406 billion. The difference between those is the amount that isn't paid, but then that amount is reduced by either late payments that are made by taxpayers or amounts that the IRS has collected through its enforcement actions. So even after all of the work that the IRS does to collect late tax and get late payments from taxpayers, we're still looking at a $406 billion deficit a year in taxes that aren't being paid. So Sarah, did you want to go over to I think we've got a polling question.
Yes, we've got a polling question now. Chrissy, if you'll pull that up. Yeah, so our polling question deals with that tax gap. So what do you think is of the 3 types of noncompliance that contribute to the tax gap, which do you think is the largest? Filing a tax return but underreporting the amount of tax due on that return, not paying the amount of tax due, just filing a return but not paying, or not filing a tax return at all, or if you're just not sure. If you'll just select one of those, and we'll leave this poll open for a minute, and then we'll show you what what you guys are all thinking. So the first option is to file a return but not report all of the tax due. The second is to file a return but not pay the tax that's due. And the third is not filing a tax return at all. And fourth is just not sure. So Chrissy, can you show us, close that poll now and show us the results for it, if you will. All right, 52% of you are saying underreporting of tax. That's great, and about split evenly the other between not paying and not filing. So great. Good. So Anne, tell us what the real answer is there.
Yeah, so it looks like about half the people got it right. When you look at the tax gap in its entirety, 84% of it, or $387 billion, is actually due to underreporting. So those are taxpayers who actually bothered to file a return and did it timely and actually paid the tax that was owed on the return timely. But the problem was they were underreporting their tax liabilities. Now, they don't break down this amount to whether or not that was a willful underreporting, as in that they knew that they were, purposely leaving information off the return or income off the return, or whether it was just simply mistakes either due to facts or to understanding of tax law. But nonetheless, the majority of the tax gap is due to actual underreporting. And then underpayment, which is when they filed a timely return but just didn't pay the tax shown on the return, that was about 9% or $39 billion. And then the non-filing, surprisingly, at least to me, was the smallest. It was only 7% of the tax gap was related to taxpayers who don't file returns at all and don't pay their taxes. And I think, a lot of times it seems like the perception might be that the tax protesters or the people who don't file returns and just try and stay off the grid or just refuse to pay their taxes, that those seem to be the biggest problem. And in fact, that's not, it's still a $32 billion problem, which is not a small amount of money. But when you look at the actual reason for the tax gap, you realize that it is actually taxpayers who are technically being compliant by filing their returns and paying their taxes. We just have a massive underreporting issue. So we're going to see this particular issue as we talk about some different things. David's going to talk about some of the stuff the IRS is doing to address this. So we wanted to give you this information first so that we sort of had a baseline and understanding as to why the IRS is so interested in doing audits and stuff like that. And it's because this is where most of the money is not being collected. So let's go ahead and look at the primary causes of the tax gap. We looked at the reasons for noncompliance. These are the three biggest causes. The first one is IRS resource trade-offs. So we've talked about this before, and I'm sure you've heard this from other places. The IRS's budget and staffing levels have fallen pretty dramatically over the past decade. I mean, when you look at the amount of revenue agents who do audits, revenue officers who do collections, even IRS counsel and other IRS staff numbers from a decade or so ago, they are significantly higher than they are now. And so adding to that with limited resources, the IRS has been facing increased responsibilities. And Sarah mentioned this at the beginning when you talk about the Tax Cuts and Jobs Act. And it's a huge piece of legislation that had so many changes to the tax code. So you're asking less IRS employees to do more. And so this is one of the causes of the tax gap, is just the fact that there's not enough IRS employees to be able to cover all of these new responsibilities that they have. Another one of the causes is limited third-party information reporting. So that would be things like 1099s, where a company that has contractors that it's paying would report the wages paid to those contractors, interactions with banks, sales of stock, all sorts of things that would be reported on that third-party information. That is one of the biggest issues with respect to the tax gap. And GAO looked at the information reporting, and when there was substantial third-party information reporting in addition to withholding, so like if you get a paycheck on a W-2 for your employer, they actually do the withholding for you, take care of paying that money over to the IRS. So where there was good reporting and good withholding, it was only a 1% effect on the tax gap. So good reporting and good withholding virtually solves the IRS's problem. Going all the way down the scale where the IRS had little or no third-party information reporting, the percentage of misreporting was 63%. So there's a huge correlation between the amount of information the IRS gets from third parties and the ability to then collect the correct amount of tax from taxpayers, which makes sense. And we'll see that when we start talking about campaigns, some of the things the IRS is interested in, they are looking into third-party reporting because they realize that the more information they can get from third parties about what taxpayers are doing, the easier it'll be to assess the correct amount against taxpayers. And then the third cause is just the complexity of the tax code, which obviously has only gotten more complex with the Tax Cuts and Jobs Act legislation. There's obviously a lot of complex rules in tax law despite multiple attempts to try to make things simpler. And this can just kind of lead to errors. I mean, we saw that underreporting was the biggest problem. And, like I said, they didn't break it down between willful and accidental, but there's a lot of accidental underreporting just due to the complexity of the tax code where people just, don't understand particular provisions, which then leads to them underreporting and then underpaying their taxes. So the GAO report sort of looked at all of these issues. They said that there's not any single approach that they can take that's really going to address all of these issues. There's a lot of different causes, and it spans different kinds of taxes and different kinds of taxpayers. So they can't just crack down, for example, on corporate taxpayers and assume that the problem would be solved. So they really have to, the IRS needs to take a multifaceted approach to how they're going to resolve this. So David, I'll turn it over to you to talk about what the IRS is doing in terms of trying to attack this underreporting issue.
Sure, and before we get there, there's been a couple of questions about how the GAO even determines the tax gap and what the error rate is on that.
Yeah, so it's based on information that the IRS gives to the GAO. Obviously, the IRS has information every year in terms of how many returns are filed and how much tax is collected on each of those returns. So that's kind of the starting point for when we were looking at the tax gap. We knew the amount, the IRS knew the amount the taxpayers had actually paid every year. When we're looking at the amount of underreporting, obviously the IRS knows when audits are done or, either when it audits a taxpayer or if there was just an automated underreporting issue, then the IRS would know that that amount would contribute to the underreporting, which, as we saw, was the biggest piece. The in terms of, the taxpayers that are out there that aren't actually paying their taxes or filing their returns, that part's just an estimate. I mean, I think the IRS, they've been doing this. They do this every year. So this is something that GAO has tracked for a really long time. The IRS, takes estimations based on prior year collections, things that they found in terms of taxpayers who just aren't paying their taxes, and then they estimate that piece. I mean, the whole number is an estimate. Obviously, it's not correct down to the penny or the dollar, or probably even to the millions of dollars. When we're talking about billions of dollars, even just a small error will be off. And then the IRS knows, obviously, the piece that reduces the tax gap is the amount of their collection efforts, and they do release a data book every year that shows how much the IRS has collected via enforcement actions, such as filing levies, filing liens against taxpayers, and engaging in other collections to get that late tax. So the GAO gets all this information for the IRS and then looks at it from year to year and figures out what kind of trends there are and then puts those numbers together.
Thanks, Ann. So let's first talk a little bit about the large business and international compliance campaigns. So Ann just told us that one of the largest contributor to tax gap was underreporting on timely filed tax returns. So it makes sense that the IRS has been placing a higher priority on, rethinking and restructuring the way it selects returns for examination to have the biggest and most efficient impact. So they can collect the most, the biggest bang for their buck. And so one of the things they rolled out in late 2017, November 2017, was their compliance campaign approach. The initial rollout had 13 compliance campaigns, and the IRS is hoping that this campaign approach will help it identify specific issues of concern, target the appropriate returns, and then examine those returns. And this has basically come about for the various resource constraints that the IRS has been facing. They've been asked to do more, from the Affordable Care Act to the implementation of the Tax Cuts and Jobs Act, with less people and less money. So this is a way for them to try to be more efficient, be a little bit more agile, and they're testing this out to see if it'll work. So again, the initial rollout was in 2017. As of April 2019, we have 53 campaigns that have been announced to the public. And again, they're trying to use the smallest amount of resources and be as efficient as possible through various treatment streams and education initiatives. The latest 3 compliance campaigns that came out were on April 16th, so the day after filing day, the day after tax day. The IRS is like, hey guys, 3 more new campaigns that we're going to look at. Most of them have an international flair for this latest release. We've got the captive service provider campaign, and so this is basically going after foreign-based captive providers, and it's a transfer pricing play. Again, the treatment stream is soft letters and issue-based examinations. So basically, the IRS is taking a closer look at multinational corporations that have foreign captive subsidiaries and making sure they're paying market rate or arm's length transactions instead of overpaying them and shifting income offshore. That's the concern there. The second campaign that was released in April is the offshore private banking. So if you've listened to us talk on these mid-year updates in the past, the IRS has had a lot of success getting the Swiss banks to start to disclose U.S.-based taxpayer information, account holders, and everything like that. IRS has been very successful with John Doe summons to the point that the Swiss banks and other similar banks have started negotiating with DOJ various disclosure agreements. IRS piggybacking off of that success with this campaign, they pretty much have a lot of this information already, and they're going to start targeting these people and other entities that have offshore bank accounts that they are aware of and that they know that these people and entities are not reporting. So that's just kind of their official announcement that they're going to start tracking on this campaign. And finally, we've got loose filed Form 5471. So apparently a lot of taxpayers are still incorrectly filing 5471s without attaching it to a tax return or an amended tax return to disclose certain foreign corporation ownership. So they are going to start targeting those, and that should be a pretty easy activity for them to target. These are the various campaign treatment streams. The ones that are the most popular at this point are the examinations. They've been calling them issue-based examinations, and soft letters, which is the IRS kind of saying, hey, we noticed you engaged in this type of transaction, or we noticed you're involved in this type of activity. Could you please tell us a little bit more about it and why you're doing it? You do not have to respond to soft letters, but basically if you fail to respond, you are inviting an examination. So a soft letter is kind of a first shot across the bow. So we would encourage you to respond to a soft letter if you get one. Internal training efforts have been boosted immensely at the IRS with these campaign treatment streams. LB&I and even SBSE have been involved in some of these trainings, and they've issued a lot of practice units which are made publicly available so you can kind of see how the IRS is going to analyze and approach a particular campaign, because you have the same training materials in large part that have been provided to the revenue agents. And there's been a lot of practitioner outreach. In fact, Sarah, do you want to tell us a little bit about the examples of the impact of some of these earlier LB&I campaigns and what's happened? Sarah, are you there?
Yes, sorry. So with S corporations, there were three common reporting issues that the IRS had identified. Two examples would be, one, reporting losses or claiming losses when there was no basis in the S corporation shares to support those losses. And secondly, had to do with distributions. Distributions in excess of basis were not being picked up as taxable income. So what's really happened is you can see that they were going to do some issue-based examinations. They were going to make some form changes and outreach. Well, the outreach, they've put additional information into the instructions. They've put some information into publications. They have reached out to the practitioner communities and talked about this. It's been part of the training at the IRS's National Tax Forums. And also form changes. When they were going through making changes to all of the tax filing forms this year, they added a new checkbox and a new requirement to actually attach S corporation basis calculations to Form 1040 if a loss was being taken, or there was a distribution, or there was a sale of the unit of the shares. So they actually have acted on this in a way that invites more information being gathered to help to alleviate this error. Second, on the virtual currency one, this is your Bitcoin, your Libra. This brings up new information or new attention because of Facebook's announcement of their new cryptocurrency Libra that they're hoping to get out next year. Outreach right now, you can hear the IRS talking at a number of conferences about cryptocurrency. They have announced that they are set to start exams based on the information they received through a John Doe summons to Coinbase, a wallet for cryptocurrencies. And you can also see that this is associated with the wage and income reporting section, WIC. And so we can expect that there'll be some more guidance coming out. They've said we're going to issue additional guidance on virtual currencies, and I would expect that there will be some reporting, like similar to 1099 reporting out of brokerage accounts. I think we're going to start seeing some of that same kind of reporting coming for virtual currency wallets and handling of those transactions. So we'll just have to see what comes next, but we know that they are moving forward and acting on these campaigns, even if it's not exactly all from an examination standpoint. So Dave, what else is going on with examinations?
So another thing that the IRS rolled out this past May was the Large Corporate Compliance Program. And so this is going to replace the old Coordinated Industry Case Program. And so the IRS is, adding this as part of their portfolio management package, that efficiency, that agile stuff we were talking about earlier. And they're going to start using data analytics a lot more, even some AI, to identify the population of the largest and most complex taxpayers and what issues they should examine of those taxpayers to generate the most revenue or the best results and the least amount of no change letters. And so under the CIC program, that was more regional based and a manual selection process. So each kind of region across the country varied as to what they were targeting in the CIC program. This LCC program is going to be a lot more uniform as to what gets targeted. It's going to be driven a lot more by data and automated intelligence. So, hopefully the IRS is going to have to use less resources and be more efficient in their examination processes. Now, again, this is targeted to the largest and most complex corporate taxpayers. But if this is successful, then we are going to see this roll down to the mid-market. We're going to see it roll down to small business and self-employed, and we may even see it roll down to the individual level. So again, I think this is a program to watch to see if it is successful, to see if it's picking the right things, to see if the IRS is getting large adjustments out of exams that are selected through this program. And if that happens, this is going to trickle down to the mid-market, it's going to trickle down to the mom and pop shops, and it's going to trickle down to the individuals, at least in terms of the methods of audit selection. So DIF score might be replaced, or a DIF score might just become part of the data analytics that are in the LCC program for audit selection. So this is definitely something to kind of watch and see what happens.
Yeah, and it kind of gives the IRS the ability, they're sort of attacking audits on two sides. So on the one side, we've got the campaign, which leads to issue-based examination. So they're saying, this is an issue that we're having a problem with. We are going to audit returns that report this issue. The problem with that, of course, is that you could have returns that don't have any of these campaigns that nonetheless still need to be audited, which is why then they're sort of bookending it on the back end with this LCC program and saying, okay, well, where are we going to get the most amount of money? I mean, if underreporting is our biggest problem in terms of collecting tax, the taxpayers that are going to be showing the most amount of tax and having the biggest transactions are going to be the ones that are going to have more dollars of underreporting, right? If you audit an individual, you get $100 of change. You audit a large corporation, you get $100,000, of changes to the tax that's due. It's obviously much more effective. So they're bookending the issue-based examinations with this use of data analytics to say, okay, this is our target population. We are going to audit some of these returns, even if they don't have any of the issues that are under the campaigns. We nonetheless want to go after these returns because they're part of this population. And I think that's how they're going to start to bookend the campaigns, both from the mid-size and then, like David said, trickling down to the individuals, because not all 1040s would get caught up in a campaign, but there's still plenty of 1040s they want to audit. And they just have to figure out the most efficient way to do it, because random lotteries of picking returns is not a great way to do it. And we'll talk in a little bit. One of the things that is looked at is the change rate during an audit. So when you get, best case scenario for a taxpayer is you get a no change, right, at the end of an audit. Nothing changed. From the IRS's perspective, that's clearly the worst case scenario, because now they've engaged all these resources and time and efforts into this audit, and there was no additional tax that was collected at the end of it. And so I think we're just seeing the IRS is really just trying to be as smart as it possibly can in the way it audits. And the campaigns with this LCC program are sort of their way going forward. So it'll be interesting to see how this works in the next couple of years. And when we look at the rates at which different entities are audited, if we're seeing any difference at all, or if it's, I suppose they could go down, which would be great for taxpayers, but to see if they really are going up and see if the tax gap gets any smaller, because that's really going to be one of the best indicators in terms of how effective the IRS is being with this. So another issue, we talked about this when we did our webinar back in December, the appeals program. So it used to be when a taxpayer would go to appeals, you had the appeals agent, and appeals is part of the IRS, but it is an independent arm of the IRS. It's intended to be like a quasi-judicial setting where, similar to going to court, the judge does not have a bias, hopefully, one way or the other for one of the two parties, but they listen to both sides of the case and make a determination. And appeals is supposed to be independent. They're not supposed to have a bias towards the IRS. So you used to get to go as a taxpayer and meet with appeals, present your case, discuss any issues that were there, and appeals would render a decision. So the IRS updated the Internal Revenue Manual in October of 2016 and said appeals now has the right to be able to invite either IRS Chief Counsel and or exam, so the revenue agent who had actually done the examination, to the appeals conference. And then they can also invite any other expert that they think might be useful. So that didn't really go over all that well, but people figured, well, okay, just because they updated the IRM doesn't make it necessarily something they're going to enforce. So in May 2017, they implemented a 2-year pilot program under which they would give appeals the ability to invite those representatives for certain cases. And they didn't really explain which cases those were going to be. They just said appeals can effectively do it in these certain cases when they feel like doing so. And in addition to inviting exam, again, appeals could invite Chief Counsel to attend. Taxpayers did not like this change. It was just sort of, as soon as it was announced, taxpayers and tax practitioners had sort of a negative reaction to it by saying, well, now you're taking away, we used to be able to have a conversation with appeals, and now it's just going to become a bickering match between us and exam. We've already dealt with exam, and it didn't go well, which is why we're in appeals. If you bring exam to the appeals table, we're going to be at the same loggerheads, and appeals is just going to watch us have the argument we had down below. It's not effective. And it's not like exam's voice can't be heard. Obviously, they have their revenue agent report and they have their documentation that goes to appeals. So appeals knows what exam's position is. It just stops the arguing at the appeals level. Now you're going to have a room full of people going back and forth. And so anyway, so nobody was particularly thrilled about it. I had a case in which appeals invited both exam, which actually was not the problem. Exam was fine, and we were kind of in agreement with them, obviously not in total, or we wouldn't have been in appeals. But then Chief Counsel all of a sudden waltzed in the door, and they had not previously had any involvement whatsoever in this case, and really just took us down this road that was unnecessary and unproductive, and ended up making the whole appeals process go way longer, and result in actually a much less favorable outcome for the taxpayer. But it was just very frustrating to us because it felt like, we had spent all this time at exam developing this case, then we went to appeals, we thought that it would have kind of been narrowed down. All of a sudden, Chief Counsel came in, sort of took it down a different path, and it ended up being a lot more work, and then ultimately we were less successful. And other tax practitioners had sort of similar experiences. So in January of 2018, the Taxpayer Advocate issued their report, and they said that the participation of exam and Chief Counsel was one of the most significant problems in 2017 for the IRS. So the Taxpayer Advocate didn't even like this. So everybody is screaming, this program is terrible, please don't do it. The IRS continued to defend it. In every conference that I ever went to, they defended this position. They said that it's going to lead to better resolution. They would not budge on this position. So in May of 2019, which was the end of the 2-year period, they decided to extend it for another year through May 2020, insisting that this was going to be the way to do it. They had said back in 2017 that they were going to issue some surveys and ask for people's input and how they felt. That was never done. When they said they were going to extend it in May of 2019, they again reiterated that they were going to send out surveys and ask taxpayers and tax professionals how they felt about it. We still haven't seen anything like that. So we're sort of in the spot where this is seeming to be where appeals is still going with this. And hopefully at some point they will take into account our feedback and decide whether or not to proceed. But that's kind of where we stand right now. So we had talked about it back in December, and it will live on for another year. So moving on from that, another big change, obviously we've had the partnership audit regime has totally been turned on its head from the legislation. Was enacted back in 2015, but it kicked in for tax years that began on January 1st of 2018. So this filing season in 2019 is the first year that we're really filing these partnership returns that are going to be impacted by the new rules. The IRS has issued a ton of proposed regulations, a ton of final regulations. They have issued a lot of guidance on this, which has been helpful. They've also revised not only the 1065, but some of the other attachments to it to take into account these new rules. And then they've issued a lot of new forms as well to handle some of the different issues that are going to come up, both in the partnership reporting and then also when a partnership wants to make changes to its return. So one of the main drivers behind this change was that the IRS had historically audited less than 1% of partnership returns. So of all the Forms 1065 that were filed, less than 1% of them were audited, which is shockingly low when you consider how large some of these partnerships are that are out there. I mean, millions and billions of dollars are flowing through partnerships, and the IRS wasn't even auditing them. So obviously that's going to also contribute to part of the tax gap, right? Because if the partnerships are under reporting things and the IRS is never auditing them, they're never going to catch that. And so they're never going to be able to collect that money. So the big driver behind this new audit, partnership audit regime was to be able to effectively and efficiently audit more partnerships. So we'll see if that's going to be coming down the pike. And we have done webinars on that in the past. We'll probably do another one as well to kind of address these new rules because they are a pretty big change. So Sarah, I will turn it over to you for the next polling question.
That's great. Yes. So our next polling question actually asks the question whether your company or you have been impacted by the new IRS examination rules for partnership, this new centralized audit regime. So if you get a K-1 or if you operate in a partnership or operate with a partnership, then the question is, have you had to adjust your partnership agreement to identify a partnership representative? Have you been considered to elect in or out? And or maybe you've even been participating in an exam where the partnership elected into this new regime early, just for convenience. I will say that the general feeling is that are a number of new items that are on the Schedules K-1 because of Tax Cuts and Jobs Act raise some additional issues and exposures, thinking about the qualified business income reporting, the 163J business interest expense limitations, and other items. Those are now partnership level items which will be subject to potential adjustment at the partnership level if that is where the partnership is audited. So new risks and exposures there as we get ready to close this poll and talk about penalties. So David, catch us up on some insights into what's been some of the recent court cases dealing with penalties.
Sure. Thanks, Sarah. So, we'll talk a little bit about a TIGTA study, the Treasury Inspector General for Tax Administration. They've taken a closer look at penalties, particularly comparing large business international division with SPSE. And you notice that in LB&I cases, accuracy-related penalties have only been assessed about 6% of the time in the population that they selected, whereas in the population for SPSE cases, so that's going to be your individuals, your small businesses, accuracy-related penalties were assessed about 25% of the time. And so, this was kind of a big disparity that was concerning to TIGTA. Some of the reasons for this disparity are, the complexity of LB&I taxpayers. There's assets of more than $10 million. Also, that most of these larger businesses have, better resources, more tax practitioners available to them. They're employing these people full time, whereas a SPSE taxpayer is, part-time when they absolutely need to. So that may be a factor that's led to, either more assessment on the SPSE side or less assessment on the LB&I side. Also, another factor when you're looking at these larger taxpayers is that the accuracy-related penalty, it only applies when the understatement is less than 10% of the corrected tax liability. So even though there may be a significant adjustment in terms of dollars, if it's less than 10% of the corrected liability, then the penalty is not going to be asserted. So that window gets a lot bigger with the higher dollars that are involved with some of these larger taxpayers. Anyway, these results were concerning to TIGTA, and it is kind of surprising. So they went a little deeper. So again, only 519, so of 8%, had accuracy-related penalties assessed. And then, of those 519 where there's actually an assessment made, 308, so over 50%, were appealed. And of those appeal cases, almost 200 of them were actually closed before TIGTA, finished its study. And almost all of those penalties were reduced and eliminated on appeals. So TIGTA's looking at this, okay, large business international is not really assessing accuracy-related penalties that much. And then of those penalties, most of them are getting appealed. And when they get appeals, IRS appeals, they're being conceded in appeals at a pretty high rate. And so TIGTA made some recommendations to the IRS on this, and because this was concerning to them. One, we need to understand, there needs to be some sort of study conducted to understand why the penalties are not being sustained by appeals. Is it just a bargaining chip play by appeals, or does appeals genuinely think that the revenue agent did not develop their case sufficiently to support an actual-related penalty? Second kind of thing is they want to ensure proper training. Again, we've seen this a lot with all these kind of new initiatives, that training is a big piece of these. So this training is going to be examiners, supervisors, up the chain to make sure the proper procedures are being followed. Finally, in the LB&I context, we want to clear up the confusion about which examiners are ultimately responsible for the penalties. So in some of these larger audits, you've got an examination team. You've got multiple revenue agents with different functions, and nobody really wants to own the penalty or own the write-up for the penalty, and so it doesn't get done, and so the penalty doesn't get assessed. So that that's one thing. That at the SBSE level, that doesn't really happen because you generally only have one IRS examiner and maybe an IRS engineer who's focused on a specific issue. And if that engineer wants to, do a 6676 penalty for a R&D credit on a refund claim or an actual penalty on some sort of valuation issue, then that IRS engineer is going to do the penalty write-up when they, adjust the valuation. So the kind of workflow is a little bit more clear at the small business self-employed level than it is at the LB&I level. So Tigda wants them to clear up the workflow and who owns penalties at the LB&I level. And finally, want to ensure that you've got the right quality control procedures in place. Make sure that, that adequately is supporting penalty decisions. So my prediction in coming up, given this Tigda report, is exam teams are going to be asked to provide a lot more detailed justification and explanation for a decision not to assert a penalty. And so the non-assertion write-up is just going to be just as tough as the actual write-up to assert the penalty. So I think we'll also see an increase in the assertion of actual-related penalties, under 6662 by LB&I in particular in the future. So be more penalties at the end in revenue agent reports, at the end of exams that the taxpayers and practitioners are going to have to deal with. Another reason that may have been an impact for the low assertion rate of penalties in LB&I is Section 6751 of the Internal Revenue Code, which has been in there forever, and nobody really bothered to dig deep and challenge it until the last couple of years. Now there have been several cases on this. The IRS has, I guess, ultimately kind of prevailed in all of them that have actually gone to court, but they've conceded all the ones that they knew they weren't going to prevail, so that's kind of misleading. But basically, you have to get written managerial approval. The immediate supervisor of the examining agent, the appropriate examining agent, has to approve the assertion of a penalty that's not automatically computed by a computer. So an accuracy penalty, your failure to file a penalty, failure to pay, those types of penalties, failure to make estimated tax payments, those are kind of automatically computed by the computer. So those do not require written approval by the supervisor, but other penalties do. So that may be a reason for kind of a low assertion rate because proper procedures weren't followed. Again, the crucial factor here is it's got to be determined by a person in order for 6751B to apply. And it's got to be done before the initial assessment. Now, what is the initial assessment is kind of a question that's up in the air. It could be when the revenue agent report is complete, when the notice of deficiency is sent out. That's going to be a kind of case-by-case thing. So that is a part that the IRS will struggle with on a procedural basis. But, Chief Counsel has issued a bunch of guidance to its employees. There's been a lot of internal guidance issued to revenue agents and managers about what needs to be done, and there's new internal forms that have been generated to kind of make sure that they don't have a lot of 6751B issues. So I think over the next couple of years, this will eventually become a non-issue and kind of a last-ditch argument for taxpayers. But it's one worth making because it is part, if it ends up in court, it is part of the IRS's burden of production and burden of proof in court. So they're going to have to actually produce this written documentation, this written approval from the immediate supervisor in order for the penalty to be sustained in court. along with the other, actual grounds for the penalty. So it's something to track. I do think while this is a hot issue now, it will kind of phase out as the IRS adjusts its internal processes and procedures to do a better job of this. Now, I said the IRS has prevailed in all the cases that have actually been tried. But again, that is very misleading because they have conceded the penalty in all the cases where they weren't going to be able to produce this documentation, which is why there's not really a positive result for a taxpayer in the cases other than establishing the burden of proof and the burden of production, because the IRS has just been conceding penalties right and left. Another thing to think about with 6751B is this will actually come up on collection matters as well, because it's going to be part of the assessment verification procedures that a revenue officer or an appeals settlement officer is going to have to go through on the collection due process side. So it is something to keep in your back pocket there if you find yourself in the middle of a collections issue. 6751B can pop up there. And sometimes taxpayers do actually win. Ann?
Yeah, so speaking of, this is another case out of tax court, different penalty. It's a trust fund recovery penalty. That's the penalty that is assessed against a CEO, a CFO, a president, a vice president, someone within a company that was responsible for the payment of taxes, of payroll taxes specifically, when those weren't paid. So a company doesn't have payroll taxes paid, the IRS can actually, of course they make the assessment against the company itself, they can actually make assessments against the individuals who are responsible for making sure that those payroll taxes were paid. That's called the trust fund recovery penalty. So it is different from the accuracy-related penalty. But in these cases, the amount that's assessed against the individuals is based on the Form 941, which is a payroll tax return. And so because of that, the IRS has to send a notice to the individual that they're going to assess. Because unlike with a 1040, that you might file and have signed, if the IRS is going to make an assessment against you for that, you are aware of what is going on. Here, you didn't file the 941 potentially or know what was on there, so the IRS has to send you a warning saying, we are going to make this assessment against you. You have the right to contest it administratively and to say that you weren't, the responsible person here, or that you did not willfully fail to make sure that these taxes were paid. And so in this case, Romano Murphy, it started in tax court. It was appealed up to the 11th Circuit and remanded back down to the tax court. But here, the taxpayer argued that she got the notice and she wanted to appeal it and say, hey, I'm not a responsible party here, don't assess this against me. And the IRS did not give her the conference that she had requested at appeals, and they basically did not make a final administrative determination with respect to her protest. So they sent the notice saying, you're going to be assessed. She said, I want to contest it, and nothing ever happened. Then the IRS started engaging in collection actions, filing a lien and stuff against her. So she went through the collection action and collection due process hearing and said, you can't undertake these collection actions because there's never been a final determination with respect to this tax. So it went up to the 11th Circuit, who sent it back to the tax court, and it was ultimately determined that the IRS's failure to address her request for appeals was fatal. And so not only were the collection actions not sustained, but the assessment itself was determined to be invalid. So what happens then is you generally, this stuff takes a while. So by the time the case goes up to the 11th Circuit and is remanded back to the tax court, the IRS's assessment statute has expired because the statute of limitations runs from 3 years from the time the 941 was filed. So when the court invalidates the assessment, it means that the IRS can never go back and perfect it because the assessment statute's closed and it's too late. So this was a big win for the taxpayer because, once the court case was over, she was fine. There was nothing the IRS could do in order to be able to go back and make that assessment against her again. So some of the procedural rules sometimes might seem a little bit tricky or sometimes even a little bit silly, but taxpayers win on them quite a bit. I had a taxpayer win against me when I was with the government. It was the same thing, the trust fund recovery penalty. They said the IRS never sent her that initial notice warning her that they were going to assess her. The IRS was never able to prove that they had ever sent it. They didn't have a certified mail receipt or anything else. And so the court ultimately dismissed the case, and the statute had run, so it was too late for the IRS to make the assessment again. And so it was just a procedural hiccup. I actually don't have any question whatsoever that she was a responsible person and that she did willfully fail to pay the taxes, but that became a moot point because the IRS messed up procedurally. And there is no shortage of cases out there on things like that where the IRS is unable to proceed based on some sort of procedural misstep, and it's definitely worth looking into because hey, I mean, especially in a case that you might not win on the merits, why not win it on a technicality? So with that, Sarah, I'll turn it over to you for the next polling question.
So polling question number 3 is, have you or your company been assessed a penalty by the IRS in the last year? Yes, no, or not sure. We'll leave that up for a minute or two.
Right. So thank you, David. Yeah, we're just trying to get a feel for the activity of the IRS going on with our client base. This could be a payroll penalty, it could be an excise tax penalty, or it could be an income tax penalty. Any sort of notification from the IRS, or even an examination potential and penalties assessed there. So great. We'll leave that up for just a minute. We recognize that we're on limited time, so let's skip down to the section and have Ann talk in the last 7 or 8 minutes here about how the IRS plans to modernize and why we need some modernization. So, Ann, let's go forward from there.
All right, thanks, Sarah. There's a lot of things going on with respect to tax or IRS modernization. One of the ways it came up was in the National Taxpayer Advocate's recent report to Congress on the 2018 year. It just came out last month. They recommended 2 things. The first one was that Congress provide the IRS with additional funding to replace its 1960s era IT systems. That is not a typo. The IRS is literally using IT from the 1960s, which actually surprised me when I read that because I was not aware that IT existed in the 1960s, but apparently it did. And the IRS systems are just so unbelievably outdated, which is a huge problem on so many different levels. And then the other thing that the Taxpayer Advocate addressed was the effect of the IRS on the effect of the shutdown on the IRS, which we've talked about. The longest shutdown in history really had a huge effect. So going to the technology piece, the number 1 legislative recommendation from the Taxpayer Advocate report is that Congress provide more funding. All of this information, I'm sure many of you have tax returns that are filed electronically. Some are required to be filed electronically. Most of them have the ability to. Some still have to be filed on paper, but more and more taxpayers are filing things electronically and also making payments electronically. So clearly it's disconcerting when those things are happening with a system that is so unbelievably outdated. The IRS uses the individual master file and the business master file. They're called IMF and BMF accounts. That's where they store all of that information with respect to taxpayers. When returns are filed, when payments are made, when penalties are assessed, when adjustments are made on exam, all that information is stored in those systems, which, like I said, is based on software back from the 1960s. It is the oldest major IT system that is used in the federal government in its entirety. So one might argue that the most important agency that is handling information like this is using the oldest system, which is just crazy. The other part of the problem is that the taxpayer information is stored in over 60 separate case management systems. So a lot of times the left hand doesn't know what the right hand is doing, or the left hand and the right hand. I mean, 60 different places you could have information for a single taxpayer. They don't usually communicate with each other, and part of that problem is then leading to examinations and other issues. How can you determine whether or not a taxpayer should be examined when you're only looking at little slivers of the information related to that taxpayer at any given point in time? So one of the efforts is to move this forward. So the NTA addresses the different benefits of funding the IRS technology, most of which are relatively obvious. They want to focus on the right taxpayers and the right issues, which they can't do if they don't have all the information. And so auditing could do a much better job of selecting cases that are actually going to be productive if there was better technology to do so. The average no change rate, we talked about that before, that's sort of a measure of effectiveness of an audit, because if there's no change, then it wasn't a very effective use of time and resources. The no change rate was 23% for SBSE audits and 32% for LB&I audits, which means that over a quarter to a third of the cases that were audited resulted in no change. So what a waste of time it was for the IRS to have gone through all of the effort to audit those. And the belief kind of on everybody's part is that if the IRS had better IT systems and could use better data analytics and had a better way to store the information, they would resolve that problem. The other part of the problem is IRS serves a huge collection function for the government. They collected nearly $3.5 trillion, and the budget was only $11.43 billion, which is a pretty good return on investment for the IRS actions. But again, it's way harder to do that stuff with bad IT. So the IRS, the funding for the Business Systems Modernization, which is the plan to modernize the systems, was actually reduced by 62% from the fiscal year 2017 to fiscal year 2018, which, as we're trying to solve the problem of modernization, giving the IRS less money to do so. And the overall appropriation for this modernization was just 1% of the total appropriation of the funds given to the IRS. So I think while everybody agrees that this is a huge problem, there still are a lot of steps to be taken to move forward. So the IRS, conversely, released its own modernization plan, basically agreeing with the taxpayer advocate that this was a huge problem. They released this back in April. It is a 6-year plan, so it's not something they think can be done overnight, but over the next 6 years, this plan talks about what the IRS intends to do in order to modernize the information technology systems and then also improve services both for taxpayers and for the tax community as a whole. One of the huge issues, obviously, is protecting taxpayer data. We've all heard about breaches at the IRS of taxpayer data. Clearly, they hold some incredibly sensitive information for all of our nation's taxpayers. So that's a huge focus of theirs, is to protect that information. The plan's going to be in 2 3-year phases, so we'll see what happens in the next couple of years. The plan, says that they're going to monitor the progress and make adjustments accordingly based on how things are going or not going well. The estimated cost is $2.3 to $2.7 billion over the next 6 years, so this is not a cheap undertaking. However, it's been determined that it is going to be way cheaper to maintain a higher level of IT than it will be to modernize this. So once we get it modernized, if we can just maintain it over time, which has not been what's happening, it ought to cost a lot less money in the long run. But since we're staring at decades and decades old IT systems, it's going to cost a lot of money to fix it. So the plan talks about the 4 pillars. Basically, what are the things the IRS wants to try to address? The taxpayer experience, that'll include expanding digital options for taxpayers, giving you more ability to do stuff online, and then also provide some simplified services for taxpayers and their representatives. Core taxpayer services and enforcement, obviously, the IRS wants to be able to up its enforcement actions because that's how they can collect money. Modernizing the operations, and then again, like I said, data protection is a huge concern for the IRS. And the IRS thinks, it's got their goals in the plan. They think that they're going to be able to improve the taxpayer experience, reducing call wait times, which would be really helpful, obviously, for those of us who call into the IRS on our client's behalf, and basically just make it all around a better system for the IRS, both internally for them to be able to select audit cases for audit better, but also for taxpayers and for tax practitioners to make it a more user-friendly system. So after this, I think, Sarah, we're going to go to our last polling question.
Yes, we are. We are at our last polling question, and it is sort of a loaded question here. Which of these statements do you expect to be true for modernizing IRS technology? Modernization of IRS technology is necessary. Modernization is expensive. Modernization can improve services to taxpayers. All of the above or none of the above. So we'll let you take a crack at that. And just along those same lines, while folks are finishing up that poll, one last comment. Why don't you talk about the Taxpayer First Act and the potential for having that signed by the President, Ann?
Yeah, so like I said, we saw the National Taxpayer Advocate report saying the IRS needs more money for modernization. We saw the IRS's modernization plan saying, as an agency, we need more money. Then we were looking at the Taxpayer First Act, which was passed by the House on June 10th and passed by the Senate on June 13th, has been sent to the President, where Congress is saying we need more money for the IRS. So there's a lot of different provisions in the bill. There's a couple of things, with respect to appeals and some other stuff, but one of the really big things is addressing the modernization issue. They want to create an internet platform for filing forms 1099, which, as we saw earlier, the lack of third-party information reporting is a huge problem. So making that easier and more electronic for third parties, the IRS is hoping will increase the amount of reporting, which will then decrease the tax gap there, allowing for tax payments by debit and credit cards. So to make that easier to do online, requiring some electronic filing for certain forms. Form 990 currently is filed on paper, but making those forms be filed electronically, which makes it easier for the IRS to process that information. And then lowering the threshold for when electronic returns are required. So currently, there's certain partnerships have to file electronically and certain ones don't. So we're hitting this modernization from all different angles. So hopefully we'll see this get signed by the President and enacted and get some more money for the IRS. So we can see them do a better job doing what they need to do, and then also having a more pleasant experience for all of us.
Great to bring them into the 21st century with the rest of us. So, and I'm sure many of you have been through some IT implementations and modernization in your own company, so you know what that's going to entail and the opportunities that can come out of it. So thank you all for your attendance today. We certainly appreciate it. And if you have issues with the IRS, please reach out to Ann or David or myself. Our contact information is here, and we appreciate your feedback. You'll be receiving a survey. We would like to know your thoughts on today's presentation and other ideas for presentations in the future. Thank you again for joining us, and you'll also, those of you that are anticipating CPE certificates, those will be out in a couple of weeks. I'm sure the July 4th holiday is going to come in the middle, so please don't look until a week or so after July 4th. So thank you all very much. We appreciate your participation.